Hello everyone, welcome back to my YouTube channel. I am Kavya. Currently, I am pursuing MBA in Sri Venkateshwara Engineering College, Bangalore. Today, I am going to explain about accounting standards, topic given by Sudhamam relating to accounting for managers subject. Let us know about the definition of accounting standards. Accounting standards are a set of principles, standards, and procedures that serve as a foundation for financial accounting policies and practices. Introduction. The basic objective of accounting is to communicate financial information to its users like shareholders, creditors, government, and other different stakeholders through financial statements. Hence, we consider accounting as a language of business. Whoever is having interest in knowing the operation of business, this information will be communicated through financial statements. Hence, we consider accounting as a language of business. It is difficult to communicate if the language is different. So, there must be uniformity in language. Hence, for effective and efficient communication, language must be same. To create uniformity in accounting by eliminating miscommunication is possible by introducing of common set of standards known as accounting standards. So, what is accounting standards? Accounting standards are rules and regulations and principles introduced to eliminate miscommunication and create uniformity in the language and information that accounting is communicating with its users. Accounting standards are basic policy document. Main aim is to ensure transparency, reliability, consistency, and comparability of financial statements. In order to compare two financial statements of different companies, both companies should follow the same rules and same set of regulations while preparing the accounts when only it is possible for the investors or other readers of the financial statement to make the proper comparison. The transaction of all companies will be recorded in a similar manner if they follow these accounting standards. The Institute of Chartered Accountant of India, in short form ICAI, has so far issued 29 accounting standards. Accounting Standard 6 on depreciation accounting has been withdrawn on the revision of Accounting Standard 10. It was on the topic of depreciation accounting. Later on, Accounting Standard 6 was withdrawn by insulting all the points in Accounting Standard 10. Accounting Standard 8 on accounting for research and development, this has been withdrawn consequence to the issue of Accounting Standard 26 on intangible asset. Right now 29 accounting standards are applicable. In that, two accounting standards are withdrawn. In that, Accounting Standard 6, Accounting Standards 8, and also Accounting Standard 30, 31, 32 were also withdrawn. As of now, there are 27 accounting standards are there. The accounting standards issued by Accounting Standard Board establish the standards which have to be compiled with the business so that the financial standards are prepared accordance with GAAP, generally accepted accounting principle. It is international accounting principles which are applied throughout the world. So this accounting standards is issued by Accounting Standard Board, requires that all the accounting standards should be implemented while preparing financial statement so that the financial statement should follow the provisions of GAAP. Now let us know about the 29 accounting standards. Accounting 1. Policies relating to accounting disclosure is a accounting standard 1. Valuation of inventories accounting standard 2. Cash flow statement accounting standards 3. Contingencies and events occurring after balance sheet date accounting standard 4. Net profit or loss for the period, prior period items and changes in accounting policies, accounting standard 5. Depreciation accounting, accounting standard 6. Contribution contracts, accounting standard 7. Accounting for research and development, accounting standard 8. Revenue recognition, accounting standard 9. Property, plant and equipment, accounting standard 10. The effects of changes in foreign exchange rates, accounting standard 11. Government grants, accounting standard 12. Accounting for investment, accounting standard 13. Accounting for amalgamation, accounting standard 14. Employee benefits, accounting standard 15. Borrowing cost, accounting standard 16. Reporting on financial segments, accounting standard 17. Disclosure of related parties transactions, accounting standard 18. Accounting policies and disclosure of lease transactions, accounting standard 19. Per share earnings or earnings per share, accounting standard 20. Preparation and presentation of consolidation financial statements, accounting standard 21. Accounting for taxation on income, accounting standard 22. Accounting for investments in associates, accounting standard 23. Discontinuing operations, accounting standard 24. Interim financial reporting, accounting standard 25. Intangible asset, accounting standard 26. Joint venture reporting of interest in financial statement, accounting standard 27. Impairment of asset, accounting standard 28. Contingent liability and contingent assets and provisions, accounting standard 29. Let us know about one by one. Policies related to accounting disclosure. Whatever accounting policies followed in the preparation of financial statement, those accounting policies should be disclosed. Valuation of inventories. Inventory means stock, the unsold stock. How to calculate the value of unsold stock? On this topic, Accounting Standard 2 has been issued. Cash flow statements. It has also become a part of the financial statement. Traditionally, financial statements were only two. They are income statement and financial position, or profit and loss statement and balance sheet. Apart from this two, one more financial statement is becoming more and more important, and that statement is cash flow statement. How to prepare the cash flow statement? What are the procedure for making cash flow statement? Contingencies and events occurring after balance sheet date. That means there is a time gap between the closing of final accounts and approval of the final accounts. Any events are happening after the date of balance sheet that have to be reported. It deals with those events which occurs after the balance sheet date. Next, Accounting Standard 5. Net profit or loss for the period, prior period items and changes in accounting policies. It deals with how to calculate the net profit, how to find out the profit prior period items and changes in the accounting policies. If the accounting policy has been changed, how it should be reported or disclosed. Next, Accounting Standard 7. Construction contracts. There are many business engaged in constructional activities. What are the provisions applicable for constructional activities? Revenue recognition. Accounting Standard 9. The standard deals with the recognition of revenue in profit and loss account of an enterprise. Revenue recognition is concerned with the revenue arising in the course of the ordinary activities of the enterprise, such as sale of goods, property, plant, and equipment. Accounting Standard 10. The objective of this standard is to prescribe the accounting treatment for property, plant, and equipment. The effects of changes in foreign exchange rates. Accounting Standard 11. As 11 lays down principles of accounting for foreign government grants. This standard deals with accounting for government grants. There are sometimes called as subsidies, cash incentives, etc., or government grants. Accounting for investments. This standard deals with accounting for investment in the financial statements of enterprises and related disclosure requirements. Accounting for amalgamations. This standard deals with accounting for amalgamations. Employee benefits. Accounting standard 15. The objective of the standard is to prescribe the accounting treatment and disclosure of employees' benefits. Borrowing cost. Accounting standard 16. This standard should be applied in accounting for borrowing cost. It does not deal with a actual or imputed cost of owner's equity. Reporting of Reporting on financial segments. Accounting standard 17. The objective of this standard is to establish principles of reporting financial information for different types of segments, products, services. Disclosure of related party transactions. This standard should be applied in reporting related parties transactions. And also, standard applies to the financial statements of each reporting enterprise. Accounting policies and disclosure on lease transactions. Accounting standard 19. The objective of this standard is to prescribe the appropriate accounting policies and disclosure in relation to finance leases and operating leases. Per share earnings or earning per share. Accounting Standard 20 prescribes principles for the determination and presentation of earnings per share, which will improve the comparison of performance among different enterprises for the same accounting period. Preparation and presentation of consolidated financial statements. Accounting Standard 21. The objective of this standard is to lay down principles and procedures for the preparation and presentation of consolidated financial statements. Accounting for taxation on income. The objective of this standard is to prescribe the accounting treatment of taxes on income, since the taxable income may be significantly different from the income displayed in financial statements due to many reasons. Accounting for investments in associates. This standard should be applied in accounting for investments in associate with the preparation and presentation of continuing operations. The objective of Accounting Standard 24 is to establish principles for reporting information about discontinuing operations. Interim financial reporting. This standard applies if an entity is required or elects to publish an interim financial report. The prime objective of the standard is to prescribe the maximum content of an interim financial report. Intangible asset. AS 26. Accounting Standard 26 prescribes the accounting treatment for intangible assets. Intangible assets refers to non monetary assets which are identifiable without physical substance. Joint venture reporting of interest in financial statements. Accounting Standard 27. The objective of Accounting Standard 27 is to set out the principles and procedures for accounting for interest in joint ventures and reporting venture assets, liabilities, income, and expenses in the financial statement. Impairment of asset. Accounting Standard 28. The objective of Accounting Standard 28 is to prescribe the procedure that the enterprise applies to ensure that its assets are carried at no more than their recoverable amount. The asset can be reported as impaired if its carrying amount exceeds the amount to be recovered through the use or sale of the asset, and it requires the business entities to recognize an impairment loss in such cases. Contingent liabilities and contingent asset and provisions. Accounting Standard 29. The objective of Accounting Standard 29 is to ensure that appropriate recognition criteria and measurement bases are applied to provisions and contingent liabilities. Thank you for watching. If you have any thoughts of sharing anything about this topic, you can share with me in comment section. If you like my video, do comment, like and subscribe my YouTube channel. Thank you.